Welcome to STRAT this week. In today's video, we will be continuing our conversation around commercial real estate and how that's stressing the regional banking system. We'll revisit our immaculate landing scenario and talk about how that's getting priced into various areas of the market. And we will start by talking about last week's inflation report. The January CPI report came through. And what we've done here, we're looking at, as we like to do, 6-month change annualized rates here, broken out by goods in light blue, shelter in purple, and services ex shelter in green. Mike, what is important to take from the January CPI report?
Pretty much, if you look at these lines and how it played out, it was about as bad as it could have gotten. The report was about as bad as it could have been if you were hoping for imminent rate cuts. Right? Because we talked about, this is the second time we've shown this chart. The last time we talked about how the majority of the disinflation we had been experiencing that everybody was getting so excited about was happening in the goods.
Yep.
The goods sector. Shelter, the hope was that disinflation would continue. So that's your purple line. That unfortunately picked back up. And a bit alarmingly so. If you look at shelter, pretty much consists of two main components. There's owner's equivalent rent, and then there's rent of primary residence. So if you're renting your home, that would be rent of primary residence. That area continued to disinflate, but owner's equivalent rent picked back up, which is more so based on underlying strength within the single family housing market, right? Home prices aren't directly reflected in CPI, but the home prices are turned into an owner's equivalent rent metric. So that was a bit alarming. The purple line ticking back up. And then probably the most worrisome is that services excluding shelter portion picking up even further. I mean, now over the past 6 months, 5.7% annualized inflation over the past 6 months. So if you're a Fed voting member and you're worried about everything we've talked about thus far year to date that you should be worried about. You're worried about prematurely cutting rates and reliving the mistakes of the 1970s, cutting rates into a potential wage price spiral. That green line going up plays into all those worries. That should really put you on hold.
Yeah. We talked about how, going into the late January FOMC meeting, the Fed could point to, wanting more information, especially on the inflation front before moving. This is not exactly the type of information they were looking for to become more confident to start cutting rates. So thanks for breaking that down for us. Definitely something to keep our eye on going forward.
One other thing to say here is we want to reiterate, as we were saying, coming into the report, that the January CPI report is volatile and cyclical. Is the market going to take this as fact? Probably not. They'll take it with a grain of salt.
Sure.
But what it does is put so much pressure on the February CPI report. That has to show a continuation of the disinflation we saw late in 2023, or else markets will get very concerned. If February we see more progress, then you would sort of write off January. That would be nice.
Right.
And then the other thing, if you couple this with PPI, Producer Price Index, that came in last week that was hotter than expected, you can take those two reports, CPI and PPI, and estimate PCE, core PCE, which comes out later this month, which is the Fed's preferred inflation gauge. And so now January PCE is going to be hot. If PPI was hot and CPI was hot, PCE is going to be hot. So once again, it puts so much pressure on the February inflation reports. Those need to come down, or else cuts are going to get pushed back even further. And they've already been pushed back quite a bit just over the past few weeks.
Yeah. So the January CPI report putting more pressure on the February CPI report, also putting some upward pressure on Treasury yields, right? Last week. So you have the market taking into account a little bit hotter inflation picture, also trying to take into account what that could mean for the Fed. And like we just referenced, pushing off those potential rate cuts further into the future, right? This idea of higher for longer on the yield front. Anything else we should talk through on the fixed income side?
Yeah, as we were heading into the year, there was an over 50% chance of rate cuts in March, and about 1.5% worth of cuts priced in for the whole year. And now you look at that, and March is totally off the table. The market is not expecting a cut in March. June and July meetings are the first time you get a full cut priced in. So a huge difference. And you see that reflected in bond yields.
Yeah.
Yep.
Yeah. So I think that's a good place to take us into the immaculate landing, right? And checking back in on
The elusive
immaculate landing scenario, right? And just to remind our viewers, this idea centers around the potential outcome that the Fed pulls it off, so to speak, right? They are able to lower the federal funds rate, tame inflation without entering the economy into a recession, and various asset prices just go on their merry way and continue increasing.
Yep.
And so what we've got here, I'll obviously let you break down the different components of it, but we've got our starting point as of the end of October of 2023. The idea being that's when the market started to price in this immaculate landing scenario. That's when we started to see these slower, softer inflation prints, and the idea started to become the base case, if you will. So walk our viewers through, what are these different components? What's been happening here? Where are we on the spectrum of the market is expecting the immaculate landing to it's expecting some other type of scenario?
Yeah, just reinforcing this idea that the market moves well ahead of the data. So the market would start to price in an immaculate landing, perhaps even before the Fed made their first cut of the cutting cycle. And going up at the top for the dominant market regime here, immaculate landing, we had gotten to over 100% priced in. And we've since retreated a little bit. We're now 87% priced in. That's the lowest that this regime has been reflected or priced into markets since about mid-January. And this overall market pricing is reflective of these seven underlying indicators. Indicators. All of them are forward-looking. They cover different areas of financial markets. And we set up price targets for each one of these that we think, hey, if we get to these numbers, that would be consistent with the market expecting an immaculate landing. So it's a bit of an art and a science, but we can sort of walk through what's going on here. Your first three are primarily around fixed income and inflation. They tend to move first. So what we've seen here, if you look at the Fed funds futures implied change in the Fed funds rate over the next 12 months, that's just how many cuts are priced into the market. We started out on October 31st at 33 basis points of cuts. So end of October, that was higher for longer, cuts might not even happen. Basically only one cut was built into expectations. And then from October 31st through about mid-January, we got to 1.6% of cuts. Our target for the immaculate landing was to expect about 1.5. So more than reflecting our price target, getting to over 100% priced. And since then, we've retreated about half as much as the peak. Now we're down to 86 basis points of cuts, which is actually a little less than our forecast. We've retreated quite a bit because of the hot jobs report, because of the tone of the January FOMC meeting, and because of the inflation prints we've been getting and the economic data. So, and then speaking of those inflation prints, looking at 2-year break-even inflation rates. So if you look out at the bond market, how much inflation is the bond market expecting over the next 2 years? At the end of October, it was 2.26, which was, that's about in line with the Fed's 2% stated target. Before we started getting, December, January payroll numbers, inflation numbers, the market had gotten down to less than 2% break-even inflation, fully pricing in an immaculate landing. And we have since gone the opposite way. 2-year inflation expectations are now higher than they were last October. They're the highest they've been in, over a year now. 2.62 is not compatible with any type of landing. That's more compatible with higher for longer, maybe no cuts this year at all.
No landing type scenario.
So this is concerning. And it's also, if you look at other measures of yield curve spreads, Fed funds futures implied 2-year yield curve spread, same type of thing. We made a lot of progress and have since retreated. So these first three, we talked about how the fixed income futures areas of the market, they would start pricing out the immaculate landing first because of the strong data, the hot inflation, the strong payroll data we've been getting. But then there's a bit of a disconnect, right? Economic surprise and financial conditions, still very strong economic surprise, great news. Financial conditions, very loose.
Yep.
And then we start to get into the more traditional financial pricing metrics, areas of financial markets everybody's sort of familiar with. Credit spreads, extremely tight, fully priced in the immaculate landing. S&P forward PE ratio, we thought 22 times would be consistent with immaculate landing. That 22 times that would be the same PE ratio we had during 2021, but during 2021, the Fed funds rate was at 0.
Near 0.
So, but we're well beyond that. We're at 24 times earnings, which puts you at an earnings yield around 4%, which is not very attractive compared to, you can still get cash yields above 5, right? So that's still very much pricing in perfection.
Yeah.
And then forward earnings growth, earnings expectations are rising. The consensus now is 10.9% earnings growth for the S&P 500. And you have to really think about that in two different buckets, right? Because you have the Magnificent Seven, they're 30% of the S&P 500, and the expectations there are extremely high. I mean, NVIDIA reports this week, the consensus, sell-side consensus is that NVIDIA is going to grow earnings by 270% this year. So we'll see. I mean, clearly analysts haven't been great at forecasting NVIDIA's earnings. If that comes in at 200% earnings growth, that could be very disappointing. At face value, you'd say that's still great, obviously, but it's all based on expectations. So to summarize this, the immaculate landing starting to get priced out because of what's going on in bond markets, what's going on with the payroll data, what's going on with the inflation data, has not yet translated into wider credit spreads or lower S&P 500 prices, right? Lower PE ratios or earnings growth estimates coming down. Not to say it won't, but we look at these prices, the forward PE ratio for the S&P credit spreads, they are on much softer footing now because of how much the immaculate landing is starting to get priced out of fixed income markets.
Yeah. It's like this idea of these prices have been able to move in this direction with the expectation that these numbers would allow the Fed to pull off the immaculate landing.
Right.
And what's interesting now is these numbers are starting to move, starting to suggest the Fed maybe can't, maybe won't be able to cut rates, certainly as much as expected coming into the year. But all of these prices still either aren't digesting that message or are digesting some other message that maybe seen through the tea leaves or something like that. So very interesting. Very interesting stuff there.
Yep. Goes back to what we've said all along. S&P 500, equity prices, the expensive areas of the market are very vulnerable until the Fed actually starts cutting.
Yep. And you can see some of that vulnerability last week in the equity returns. Large growth is the one red spot on the board for last week, down 1.2%. That's the area we're specifically talking about when we talk Mag 7, 30+% of the S&P 500.
Yep.
That's the spot.
Yep, exactly. And once again, going back to NVIDIA earnings coming out this week, the past few earnings releases for NVIDIA have sparked a bit of a consolidation period for the Mag 7. So we'll see if that ultimately plays out. I mean, NVIDIA has been performing very well coming into earnings, which also has been happening the last few earnings releases. So we'll see how that plays out. We're also seeing a bit of a rebound in the smaller cap areas of the market, particularly small value, which is nice to see given all the concerns about commercial real estate.
Yeah, small value, right? We talked large growth, the one red spot on the 1 week column, small value, one of two red spots in the year-to-date column. What's been driving that significantly year-to-date is regional banks, mostly reside in that small value space. Regional banks been brought under pressure by commercial real estate. We talked about this a little bit last week, providing some additional information here in terms of the CRE stress index, and then comparing that to the S&P 1500 financials index. What's important for our viewers to take away from this chart?
Basically, this is something we'll probably bring out throughout the year. It's sort of real-time monitoring of the problem, how big it is, and does the market care about it. So what we've done is we've created a CRE stress index, and this consists of a handful of small and mid-sized banks, publicly traded, obviously, and these are their stock prices. The index is market cap weighted, and the banks that were selected because commercial real estate exposure exceeds 300% of capital. Which is an important regulatory threshold. If you have more than that in terms of commercial real estate on your books, regulators sounds like they're going to be on you and force you to set aside for potential loan losses, which we know in the case of New York Community Bank Corp was the straw that broke the camel's back.
Yep.
And also that have grown their commercial real estate portfolio either organically or through acquisition by at least 50% over the past 3 years. So they're the most at risk. So those banks go into the CRE stress index. Like I said, it's market cap weighted. You can see the dramatic underperformance versus the S&P 1500 financials index. That downturn is New York Community Bank Corp's earnings, which cascaded into fears for banks like Valley National and others. But since then, we're seeing sort of a consolidation, hopes that, these fears won't be realized in other banks in the sector. Clearly, it's not a concern, right? Other financials. And similarly, if you look at larger banks, this is not something that's, could be an earnings headwind, but this is by and large a problem for smaller, mid-sized, and community banks. So this will be something we'll be monitoring throughout the year.
Gotcha. Makes sense.
Yeah.
All right, should we wrap up with the investment framework?
Let's do it.
Economic growth. Anything new to report on in terms of economic growth expectations?
Housing starts and retail sales were a little weak. So if you look at how that translates into tracking for Q1 GDP and even the Q4 number, it brought those down a little bit, but still something above 2% in terms of Q1 GDP, which is just fine. It's exceeding expectations. So you see that reflected in our forecast coming down, but in our forecast horizon, so slowing to a more sustainable pace, but that end point of our forecast horizon is actually higher than it was at the beginning of the year. So coming down to a better run rate.
Sure.
A more tolerable run rate.
Gotcha.
Yep.
And then from an inflation standpoint, projections still in the 3.4% range for CPI 12 months out. Mm-hmm. Anything to add on there?
Yeah, January was going to be the month that we were hoping the end point of our forecast for core CPI would dip below 3, but yeah, it was a hot report, and so not quite there.
Yeah. And then liquidity, we've talked a few times this year about how we expect that to become more attractive in the second half of the year. Mm-hmm. You can see the improvement here from 23 into 24 based on the projections.
Yep. Anything
else you want to add on that?
We're really watching to see if rate cuts in June and July start to get priced out. That would cause us to revisit our liquidity forecast because that's when we think the cuts would start.
Right.
That would cause us to revisit our liquidity forecast and also would cause us to revisit the idea that those areas of the equity market that have broadly been left behind in the past 2 years could outperform in an improving liquidity environment in the back half of the year.
Yep.
So we're not there yet.
Not quite.
June and July cuts are still priced in. It once again just puts a lot of pressure on the February CPI numbers and then also what happens at the March meeting, the March FOMC meeting.
Sure.
Yep.
Sure. All right. And then we'll wrap up with the recession signal remains inactive, like we talked about from the immaculate landing standpoint. All of these market stress signals, a long ways away from trigger levels. So inactive recession signal. Nothing too exciting to report there at this point. Cool. Well, that'll do it for this version of CapStrat this week. If you have any questions or comments, please feel free to reach out. Thanks.